Hi, I'm Wendy Bosch, one of Bill O'Neill's portfolio managers, and this lesson highlights the portfolio management techniques that we follow. This topic is important because correct portfolio management can be the difference between a person who makes 10 or 20% a year and a person who makes 60, 80, 100% or more a year, even though both could be buying the exact same stocks. The difference lies in portfolio management strategy. I believe buying stocks is the easiest part of investing. How you handle them is the toughest. This includes factors such as how large or small your position sizes are, when and in which stocks you take your profits, and it involves adding money to your winning investments. The key is recognizing and capitalizing on your best stocks and cutting out the losers or weaker performers. We find the leaders and we move our money into those stocks. This most likely is going to be more of an aggressive style of trading than you're used to, mainly because we are more concentrated and less diversified. The investment community emphasizes diversification because it's less risky. That's true if you plan on being hands-off with your investments and your goal is more modest returns. But if you are someone who desires to actively invest for yourself and achieve higher returns, then you can use our more concentrated management style. It can yield substantial profits if you make the effort. And as long as you adhere to sell rules, we believe our style is less risky than diversifying without sell rules or diversifying without cutting losses short or just buying and holding for the long term. We think that's gambling. Let's delve into how we do this. Beginning with the basics, a big key to your success is pretty simple. How many stocks do you own? These are suggestions of how many stocks to own depending on your portfolio size. We suggest owning 5 to 6 stocks if you're managing $100,000 to $1 million. If you're managing $1 to $5 million, we suggest 6 to 8 stocks. Over $5 million, 7 to 8 stocks. 8 stocks is normally your maximum number, but you need to know how many stocks you plan on owning so you can plan your position sizes accordingly. For some of you, this may feel too risky. In this case, if you do own 20 or more stocks, try to whittle it down to 10 or 12. Superior performance is not achieved with a 20-stock portfolio. Normally, with more than 8 stocks, you start watering down your results and you can end up with a handful of mediocre stocks. Also, it's difficult to closely watch 18 or 20 stocks with all the news updates and earnings announcements and keeping up with the industry and the competitors. Your attention will be scattered. On a side note, if you own so few stocks, we suggest only buying stocks with liquidity, meaning large amounts of trading volume. Thinly traded stocks tend to be really volatile, they're riskier, and they fall faster. Generally, we consider thin as having an average daily volume less than 500,000 shares. Our next guideline for portfolio management is how we establish our position sizes. But in determining position sizes, you need to know how leveraged you will be. If you are a new investor, don't leverage your money. Eventually, this is something you can ease into. But for the more seasoned investors, if you are going to trade on margin, there are some conditions. You must have a couple of years of experience and feel pretty proficient with our system. You must understand the risks of margin. You also must be disciplined with your rules and have proven that you will cut all your losses. If you are 200% invested, which is fully margined, you can make money twice as fast, but you can also lose your money twice as fast. Trading on margin can be dangerous without sell rules. Let's figure out position sizes. We'll look at a typical portfolio and say you have $100,000. Owning 5 stocks is your goal, and you choose to be fully invested, so that's $20,000 for each position. Now, to establish a position, we don't dive in all at once, but we make 3 purchases to get our full position. As our stock moves up, we add to it. This way, we're only putting more money into what's working. This reduces our risk by placing our money into stocks that are proving themselves. This is called pyramiding or averaging up. The initial purchase should be roughly 50% of your position. That's $10,000. Then, as the stock moves up 2% or so, add 30% of the full position, so in this case, $6,000. Then when it's up 5% from the pivot point, add the final 20%, the final $4,000. Notice that we are putting the same amount in each stock. An important point is that you want to keep all of your position sizes equal instead of having some small and some large positions. So in this case, they were $20,000 each. And that's because the eventual goal is to have the most amount of money in your best stocks. But in the beginning of a move, you don't know which stocks will become your best holdings. So in order to force feed properly down the line, it's imperative that they all be equal position sizes in the beginning. Otherwise, you may have a small position that works out and a large position that fails, and then your portfolio is off balance. Also notice that each additional purchase, when we add to positions, is always smaller. You are only buying fewer shares when making additional buys because you don't want to run up your average cost. Also, we are not making these additional buys unless we are up on our investment. We average up, not down. Why would we put more money into a losing stock? You may get away with that once, even twice, but in the long run, your portfolio could disappear from averaging down. Market leaders fall by an average of 73% from their peaks, so don't ever let yourself get caught in a fall like that. Also, to make additional buys like this, you need to be buying pretty close to the pivot point. So don't chase a stock more than 5% past its pivot, or you are much more likely to get shaken out. Our next section is applying the force feed method. You want your best performing stocks to be your biggest positions. So in order to force feed, our goal is to figure out which stocks are the real market leaders and then put the most amount of money into those stocks. This is how we take full advantage of our leaders. The force feed method is moving money out of our weaker performing stocks and into our leading stocks. So we're shifting money from our losers to our leaders. So we'll often sell a stock simply because it's up the least, even if we really like the company. And then we'll put that money towards a stock that's run up the most. Let the market tell you your leaders. Don't rely on your own opinion because ultimately it's the market that's right. The force feed method is done in a strong bull market, and it's how we make a lot of money, through recognizing our leaders and then capitalizing on them. Also note, I'm only applying the force feed method when I believe I own a market leader, a really outstanding stock. So often, it's just one or two stocks that we will add money to. We don't do this for every stock in our portfolio. For most investments, our goal is to take that 20 to 25% gain. We have a horse race analogy. At the beginning of a bull market, you're watching and looking for the best stocks, the leaders. The leaders are the fastest horses in the race. Now let's pretend that when you're at the Derby, you're allowed to raise your bets after the race starts. That would give you a huge advantage, and this is what you can do in the stock market. This is how we treat stocks and experience great returns in the market. Let the market tell you your fastest horses. If a stock moves up quickly and forcefully, that usually means there's power behind it. Big buyers are taking interest, and it's one you'll probably want to hold and add money to. The force feed method makes so much sense, and yet so few traders actually follow it. Now we'll discuss the entry points where you should force feed. This is tricky because you want to add to your stock that's advanced the most, but you don't want to add when the price has been hitting new highs for weeks and now is sticking straight up in the air, because a correction could be right around the corner. The two most common points to add are when a stock pulls back to the 50-day moving average line the first couple of times, and as a stock breaks out of a second stage base. Leaders often pull back to the 50-day moving average line 2, 3, sometimes 4 more times before the move is over. The 50-day moving average is a standard, and institutions tend to buy quantity when a stock pulls back there. Your goal is to hold your best stock or two through these first couple of pullbacks and then add money as the price rises back up on heavy volume. This is easier said than done because the behavior of stocks is to scare you out. There's that old saying, they'll wear you out or scare you out, so you need to be prepared for these pullbacks. Expect them so you will have the courage to add to your position instead of selling it. This is Macromedia Incorporated from December 95. It broke out in October 1994 of a cup with handle. If you follow my arrow, you can see here's a very large cup with handle base. It broke out on heavy volume and then pulled right back down to that 50-day moving average line. It also pulled back right to that pivot point. So there's where you could add more shares. It moves up forcefully off the 50-day moving average line. Pulls back again. You could add it one more time there. The stock has a nice move, and then it forms now a second stage base, a much smaller cup with handle base. That's an excellent buy point there as well. Back to our previous slide, we're now on the last bullet point. The next question in force feeding is how much to add when you decide to increase your position size. This is where portfolio management becomes tricky, and it's a little bit more of an art than a science. There really isn't any magic number regarding how much you should add, but you're always adding fewer shares than you own, and then each stock will be different. A stock that has proven to be your best performer, you should be adding a larger amount to than to your second or third best performers. So let's look at our example. This is not an exact formula, but this example is going to give you an idea as to how we might force feed. So let's say you have 3 stocks you've made money on and would like to add to each of them. For example's sake, you own 10,000 shares of each. The first stock, symbol ABC, you might add 1,000 shares to it as it pulls back to that 50-day moving average line. In the second stock, your cost might be really low, and it's at a really great buy point, let's say a second stage base, so you might add 2,000 shares to that one. Then there's your third stock, XYZ. It's your largest gain and has been one of the leaders in the market. It had a recent acquisition, and now it comes out with huge earnings and sales. It undercut the 50-day and is coming back through on big volume, so you might add 3,000 shares to this one. You really think this could be your best stock. If the next day it's up another 2% on big volume, then add another 1,500 shares. So you now have a total of 14,500 shares in XYZ. You've increased that position size by 45%. I don't suggest doing this with thin stocks. So as you can see, how much you add varies on the current situation and the individual stock, but the main factor is how much you are ahead on the stock. To wrap up the force feed method, please understand that if you trade this way, you must strictly follow your rules. You are now dealing with 1 or 2 very large positions. If you don't follow your sell rules, you can get hurt with such big positions. Be able to act fast in case something goes wrong. Let me remind you that we trade this way because of the huge gains that are possible to achieve. When you stick with this system, you will see that over time, when you're getting it right, your numbers will dramatically improve. Another general rule of thumb is to make sure you're not too concentrated in one industry group. You don't want that excessive exposure to any one group, even if it is proving to be the best group. Stocks in a group tend to move together, so we usually don't have more than 2 stocks in the same group to control our risk. Next, always be aware of what quarter of the game you're in, especially when you have such large positions. If we are 2 or 3 years into a bull market and we're at a point where everything's great, the market's on a roll, it feels almost pointless to be tracking your stocks on a daily basis, that's exactly when you need to be watching the market and the action of your stocks the closest. Market tops are sneaky and occur when no one expects them to. For our next section of portfolio management guidelines, I have some action items that you should make part of your daily routine if you're serious about becoming a really great investor. First, print up charts of every transaction you make. After you buy a stock, stick the daily and weekly chart in a folder and write down your reasons for purchasing it. What looks good on the chart? What's so great about the fundamentals? Why is the product special? When you sell it, print up another chart and write down the sell rules that got you out. This way your actions will be based off of sound rules, not emotions. Being forced to follow rules will quickly improve your results. This is also going to help you perform your year-end post-analysis, which we'll discuss at the end. The second tip is important, and I think it's one of those exercises that can separate the good from the great. Review the stocks you own and highlight the ones you really believe in. If you could only own 2 or 3 stocks, which ones would they be? Things you'll want to consider is, do they have a superior product? Is the group showing strength? Is their price performance exceptional so far? Our goal is to recognize if we have a potentially big winner. This is going to help us know how to handle a stock. When the market is correcting, I'll have the courage to hold my yellow highlighted stocks and force feed money into them. You'll often find that you don't own the top 2 or 3 stocks leading the market. Figure out what those stocks are and look for opportunities to get in. For me, it's as simple as taping a Post-it note to my computer monitor with the 3 or 4 ticker symbols written down for the market leaders. I watch those stocks every day and I am ready for an opportunity to get in. Sometimes we do get a second chance if it pulls back to the 50-day or forms a flat base. Next, have a price objective for all of your investments. This is about being prepared and having a plan for when you want to sell your stock. A great investor, Gerald Loeb, wrote a book called The Battle for Investment Survival. That is an appropriate title because investing in the stock market is an ongoing battle. No one goes to battle without a strategy or they'll lose. So know your objective. Are you going to take a 20% profit, or is it one of your highlighted stocks that you want to hold through a correction or two? Next, watch the action of the general market every day. Be alert to distribution days. This is simple. Just read the daily market column in Investor's Business Daily called The Big Picture. Timing the market can be difficult, so IBD does a daily write-up interpreting the action of the major indices for you. You're going to need to be flexible at times, sometimes selling your weaker stocks if there are signs of distribution. On occasion, those stocks will turn around and go right back up, but that's okay because you need to be prepared and always protect yourself. Our last tip is that your daily routine should always include creating and reviewing watch lists. I use Daily Graph's custom screen wizard to narrow my focus to top-rated stocks based on our proprietary ratings. I run certain screens regularly to see if anything new pops up so I don't miss out on any opportunities. Our final section is about performing a post-analysis. Analyzing your previous trades is pretty crucial in becoming a great investor because it will allow you to identify your mistakes. There are long-lasting benefits to figuring out what recurring trading mistakes you make and then correcting them. This exercise can make an enormous difference in your trading returns, and we suggest doing it annually. The purpose of this is to formulate specific rules that address your weaknesses. Did you buy, hold, and sell properly? What rules did you break? Do you sell too early? Is there a weakness in your stock selection? Maybe you aren't focusing on the best in terms of relative strength. Every person's mistakes are different. Your post-analysis will be a lot easier if you print up your charts of all your transactions when you make them and then stick them in a folder. Remember, you're writing down why you bought or sold the stock. Archive as much information as possible so you can understand why you made your decisions when you do your year-end post-analysis. We suggest sorting your marked up charts by performance, starting with your biggest percent gainers all the way down to your biggest percent losers. If you're someone who trades a lot, then analyze just your largest percent gainers and largest percent losers. Look at those extremes, so you're not just discovering what you're doing wrong, but also what you're doing right. Then you also need to analyze the leading stocks in that market cycle. Analyze the big winners you missed or got shaken out of. What did they look like? How did you miss them? If you didn't get into these leaders, then one of your new rules should address this. Overall, develop just 2 or 3 rules that address your specific weaknesses. Don't make it complicated for yourself and have too many rules. Most likely, there's just a couple of major rules that should help correct most of your mistakes. William O'Neill says that the worst mistake is owning a model book stock that's a big leader and then messing it up. It's easy to do. The institutions want more of a great stock and they will do anything to scare you out. One of my personal weaknesses early on in my trading was causing me to mess up the great model book type stocks. I wasn't willing to buy stocks back that I had just sold for a loss. For some reason, it was hard for me to buy a stock back higher when I just felt burned by it. I was discovering that I was picking great leaders, but I would get shaken out and then just watch as they continuously hit new highs. My mistake wasn't getting shaken out, but it was not turning back around and buying the stock back at a higher price. Figure out what's keeping you from being in the leaders. I had to make a big effort to correct this, and the results were pretty substantial. I hope that you too will see a big difference from doing this. That concludes our portfolio management lesson. I hope these guidelines will help you become a great success in the market.